All right, everybody. Thanks again for coming to the event today. This is Patrick Zielbauer from Infinity Futures. It's 3:27 on Monday, December 3rd. My name is Patrick Zielbauer, and today's webinar is entitled Range-Based Charting Ideas for Volatile Markets. So let's go ahead and go through some risk stuff first, and then if anybody has questions about this, we'll answer those before we get started. All right, so trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. And folks, we talk a lot about day trade margin in our events and emails and things like that. Be conscious of the use of day trade margin. Make sure you understand the leverage. Leverage is a double-edged sword. Okay, if you're not sure why day trade margin is risky to use, then talk to your representative about about that before you get started. Everybody here has one, whether you're a live client or a demo user or something. So if you're not sure who to deal with, just reply back to any of the email you get from Infinity or send an email to trade@infinityfutures.com, which will get you back to our management and they will point you in the right direction. Okay? All right, so just to give everybody an idea of what we're doing here today, every Monday for the last few years, I would do live events that cover some aspect of Sierra Chart, which is a charting program that we offer and support here at Infinity. It's a great program. It's one of my favorite applications that I've ever used in my 14 years working at Infinity Futures. And in my opinion, it's the best charting program that's on the market for a ton of reasons. But one of the main reasons why I love Sierra is that it allows regular people like myself who are not programmers or developers by trade to use a program in a way that you would think you'd have to be a developer to use at that level. In other words, there are things you can do in it that you can do without being a programmer that a lot of other applications would require you to be a programmer with some history or experience outside of the trading world in development or software development, which most of our clients are not developers. The ones that are really especially love Sierra because of the way it's written and its lightweight nature and other things. But it's just a great program. And every Monday we do something different where we talk about some aspect of the charting program. Now, over the last few months, we've had a pretty heavy focus on market volatility. So instead of just teaching, here's how to make the moving average turn green when it goes up and red when it turns down, something like that, I'm trying to put this more in the context of the kinds of questions and experiences that I am, gaining from talking to my client base. In other words, I'm getting a lot of questions like, hey, Patrick, how am I supposed to use my indicators when the Dow has a 700-point range? How am I supposed to use my traditional indicators, my MACD or crossovers or this or that, when everything is just getting absolutely torn through without stopping even for a second? And it got me thinking a little bit about how we can try to help people adjust for the circumstances that we're seeing right now, which are extended volatility. So this stuff that happened over the weekend with China and the market rallying as it did today and then selling off a little bit, still at a pretty good amount of volume. The E-minis traded 1.8 million contracts today. That means there's a lot of interest. There's a lot of people participating. That's a pretty high number to have for an up day in the market like this, especially around the holidays. So what I think is happening here is the fact that this sort of trade issue is getting punted a little bit, kick the can down the road. That is going to invite a lot of volatility because there's so much speculation. So if you are thinking that the craziness is over, I'm not sure I would agree with that. And so I think it's especially important right now to consider the idea that, okay, you can keep using the decision-making tools you're used to using, but you might want to start incorporating other things that contain more relevant data. And what I mean by more relevant is, in that context, is stuff that is looking at today in terms of today's session, rather than relying only on averages or indicators that are built on days and days of data, moving averages that go 20 periods back or 50 periods back or 100 periods back, that sort of thing. So we talked about this a little bit last week. I expanded upon it a little bit over the last week or so as I was thinking about this, and I wanted to explain a little bit about what we're looking at. And what I plan to do here, just so everybody knows, is I'm going to go through each of the studies that's on these charts right now and explain what they are and why they're up here and and how you can do some of these cool things, because there are some things that we have up here right now that are, I would consider like mid-level, mid to intermediate sort of skills that I would like you to learn how to use with this program. So we'll explain how to do that as well. Okay. So that's just a kind of summary of what we're going to be doing. Now, there's 6 charts on the screen: S&P, NASDAQ, Dow, Russell, crude oil, gold. Okay. What I'm going to do first is open a brand new chart book, and I'm going to copy the Russell chart in the bottom left over into the new chart book. So I just went to File, New Chart Book. That gave us this kind of blank screen. And I'm going to click on the chart that I want to copy into that new chart book, and I'm going to go up to Chart and select Duplicate Chart to Chart Book. Okay, so that's like if you want to take a chart out of one chart book and put it in another one, you just would select that, Duplicate Chart to Chart Book. Sorry about that, hang on. Chart, Duplicate Chart to Chart Book, and then you pick the chart book that you want to duplicate it into. So I'm going to pick Chart Book 28. So I'm going to switch to that as well. So by checking this box, when I hit OK, it's going to switch us to the new chart book. So here it is. So I'll just maximize this so it takes up the whole screen. And I'm going to zoom in so that yesterday's data, okay, or Friday's session is sort of off the screen. So we can really only focus on today. Okay, so that's what we're looking at here. All right. Now, this chart looks a little bit busy compared to some of the charts that I have shown in the past. Okay, that's true. There's plenty that could be removed off the screen. I basically put a few things up here that a lot of people ask us about, and I'm gonna leave them up here for the time being. I'm also gonna show you how you can pare it back a little bit as well. All right, but let's go through what each of the lines are, and then we'll explain, how we got there, why they're up here, and I'll show you some of the mechanics as well. All right, so firstly at the bottom, this one's, should be fairly obvious. It's the CCI, Commodity Channel Index. Okay, pretty traditional oscillator. Most people here have probably used something like this or seen something like this before. There's a reason why I've got it here. I'll explain, why that is in a little bit, but I'm not going to spend a lot of time on this one, other than to make mention of the fact that the levels that you see representing these black lines are 200 and negative 200. So those are relatively extreme levels. Usually when you add a CCI to a chart, with any charting program, you're getting levels like 100 or negative 100 or negative 150 and positive 150. I like to use the 200 levels, A, because I've learned that from a lot of people that I've learned from over the years, and B, those levels are not hit very often. So what I'm really looking for is I'm looking for extreme areas that appear not to get tagged too often. And if they do get tagged, they usually don't sustain for very long. So that's the reason, the method behind having the CCI look the way it does. Okay, very simple, just the CCI with a 200 and a negative 200 level down here. Okay. Then what you're going to see are a series of lines. And what I tried to do was label the lines here with these little abbreviations, and I'll explain what they all are here in just a second. But one thing that you can do in Sierra that's really easy is create labels that can create these easy references. So like when I look down here and I see P-low, that means the previous session's low was 1518. So a lot of times if you're looking at the market or you're talking to people or in the chat room or whatever, and someone says we're approaching yesterday's low, or we're about to hit yesterday's low, there's an easy way inside Sierra using a daily open, high, low, close study to look backwards and easily plot the low of the prior session. So that's what that one means. The MPD, that stands for maximum permissible deviation. That's going to be at the core of what we're talking about. So I'm going to skip that one for now. We're going to come back to it. Then you've got the low here. That's today's low. Okay, 1527.50. Okay, that's today's low of the Russell. You've got the 0.5 MPD, which is half of the maximum permissible deviation, which we'll come back to. The previous day's high. The value area low. Okay, the value area low. The value area, for those of you who are unfamiliar, is this area between this VAH, which stands for value area high, and this VAL, which stands for value area low. That is where 70% of the volume has traded in between these two prices. This is what's called the developing value area line, because you can see the line is shifting as time goes on. That's because the value area adjusts as the market moves. So what the goal of this line is to show you always at any given moment, up to the point where we are at this current moment, 70% of the volume is traded in between these two prices. The reason why this is important is a lot of times what you'll see is a flurry of activity when the market breaks out of its value area. So there's another sort of charting idea that I've used in the past, which I call the value area breach project, which was basically looking for times when the market would bust out of that value area at the same time that CCI would be making one of these extreme levels. So that's not really the focus of this presentation, but the general idea is that when you have a value area that is being breached, that means there's usually a change in sentiment, at least for the moment, and you usually will see a flurry of activity around a value area being hit, whether it's being breached down to the bottom or coming back up through the value area low as it makes its way back towards what's called the point of control, which would be like, I don't have that visible here, but that would be usually in between these two lines somewhere. Or if the market breaches the value area to the upside, or comes back through the value area high into the value area from above the value area high up here. So in other words, it's a way for people to track the prices at which have acquired the most attention throughout the day, generally speaking. Okay, a range from the high to the low. 70% of the volume traded in between those two prices. Okay, then this blue line here is this is just the midpoint of the session. So the average of the high and the low of today. The black dotted line represents the volume weighted average price. Okay, that's something that a lot of volume-based traders or profile traders will use. Okay, it's basically exactly what it sounds like. It's the volume weighted average price. So you're getting more weight to prices that have traded a lot of contracts. Okay, that's the VWAP. Okay, if anybody's heard that term, VWAP, that's what that is. All right, then up here, you've got the value area high. You've got 50% of the maximum permissible deviation to the upside, and then the actual maximum permissible deviation up here. And then you've also got the ONH, which stands for overnight high. And then there's also the overnight low somewhere in here, which might be overwritten by one of these other lines. So that's somewhere as well. If we scroll back in time also, you're going to see these little purple lines. This represents basically the range of the high to low for the first half hour. So a lot of people are looking for the range to be established of the first half hour of the day. That's using a study that we have that's called the high-low for time period, and it's easily added to any screen where you just punch in the start time, the end time, and then put the colors of the lines that you want. You can also have those extend out in the future if you want, but in this case, I didn't do that. So just to kind of take you through why I'm doing things this way is a lot of times like our clients are starting to shift towards the idea of using predetermined levels as targets or stops. And so what I'm finding is that when people use levels as the reason for waiting on a trade or getting into or not getting into a trade, that almost by definition means they have to be patient. So what I'm trying to encourage in this kind of volatility that we're seeing right now is for people to wait until a scenario is developing that is relatively uncommon and then look for an opportunity. And that's what we're going to get to with this whole maximum permissible deviation thing. So a lot of people use Bollinger Bands or they use these standard deviation sort of based studies. And the maximum permissible deviation is basically an idea that I borrowed from Raghi at Simpler Trading. She was kind of talking about this. I don't know where she got it. But basically, I started listening to this idea a little bit, and it intrigued me because it offered the ability to create these bands that were based on today's range. So here's what the math is. All right, so see this VWAP here, the VWAP, the black dotted lines. This upper band up here here's how you get to this number. Well, here's why this is being generated where it is. What it does is it's taking the range of the day, the entire range of the high to the low of the day, and it is dividing it by 2 and then adding it to this black line. So this blue line here is the entire range of the day from top to bottom. Divide that by 2 and add it to this black line. That is this band. And then down here, the maximum permissible deviation, the one that's in maroon, is the range of the day divided by 2 subtracted from this line. So what this means is that in a wider range, you're going to get bands that are really far apart. And what that forces people to do is it takes them outside of this idea that they can only get into the trade when this line crosses this line, and instead puts things in a greater perspective of, okay, let's really remember how volatile this market is right now, and let's use this to put things in the price movement we're seeing right now in perspective. And the reason I made an allusion a moment ago to the idea of kind of foregoing these traditional indicators that look at lots of history. I find that what I'm finding right now is that we're in a unique period where a lot of times what is happening like yesterday or the day before, it becomes less and less relevant. It's really only what's happening right now that I feel is relevant in this market. I haven't always felt that way, and I probably won't feel like I do right now forever. But what I'm finding right now is that with these types of ranges, why would I want to look at a moving average that if the prior session had a range of 14 points and today's range is 100 points, why would I want yet that data from when the market was flat before this new information came out about the trade talk or whatever the catalyst is? Why would I want to incorporate that data, which is squeezing down flattening out my moving average, let's say? Why would I want to incorporate that in my trading decisions right now when the market is volatile now? I'm finding that to be counterintuitive, the idea that that is what we should be doing. Maybe I was wrong all along, thinking that that was okay in the past. But I'm finding more that I'm gravitating more towards data that is being driven by what is happening in this trading session. Not what's happening, in prior days. Okay, so that's the basis of the idea. The idea is that the wider the range of the day, the bigger these bands are going to be. And if you're going to trade based on these bands, then if the market slows down and doesn't go anywhere, you won't get trades. But if the market does reach these bands, you might see some trading opportunities and flurries of activity along the way based on these other lines being hit, like the overnight high, overnight low, value areas, the midpoint, and that sort of thing. All right. So I'm going to lay out a little bit of just kind of like a little strategy to think about. I actually have not looked at this on other markets other than the Russell over the last week. I looked at it briefly on some of these other products today. I failed to mention earlier that anybody who wants a copy of this file, just email me or your representative in our office, and I will make sure to get this to you so you can work off of it, tear it apart, put other products on it, work backwards off of it with the recording. Highly recommend you do that. Okay, it's as long as you either have a demo account with us or a live account with us, the files are yours. Okay, there's no cost of any kind associated with it. All right. Okay, and just the reason why there's people asking why the Russell. The reason why I've been looking at the Russell a lot more lately is because the contract is worth a lot less money than the other markets. So, and I haven't done the math on this as of today, but there'll be times where the Russell is the laggard, like it was a little bit today. There's be some times where the small cap indexes are the leader, like they have been historically, on different days. You will always be trading a market that on one of these days is the outlier. That's just the reality. The Nasdaq's been very volatile lately. If there's bad news out of China, the Dow is usually going to get hit the worst because all of the exposure to industrial companies that have ties to China. So there's always going to be markets, the indexes that are leading or lagging. Just accept that that's a reality, okay, and then take that reasoning for not looking at the Russell and throw it out the window. The reason why the Russell is an interesting market for someone who is either a little apprehensive or maybe gotten burned in the past or maybe just wants to go about this really quietly or carefully is that it's just worth a lot less money. Okay, the full contract value of the Russell right now, based on the current price of 1546, is roughly $77,000. Okay, take 1546, multiply it by $50 a point. That's how you get to that number, about 77,000. Whereas if you look at the Nasdaq, which is $20 a point, and the current index price is 7052, multiply that by 20 points, that's 141,000. So what that means is that the Russell contract is worth just a little over half of what the E-mini Nasdaq is worth. What that basically means is that in the Russell, you can use a wider stop percentage-wise and still not necessarily risk more money. You can afford to take a wider stop. Whereas a lot of your buddies and online trading pals who are trading the Russell or trading the Nasdaq with an 8-tick stop right now, they're getting stopped out in like 1 second. All right, in this kind of a market, you need to give these things a chance to breathe. And let's go through this idea here briefly, and then we'll work backwards through some of the mechanics. All right. Okay, so let's look at this Russell here. Here's an example of how you might look at this sort of strategy. So what this line down here, as we talked about, this is the maximum permissible deviation. Okay, so again, that is the VWAP minus half of the range of the day. What I also did was I divided that half of the range by 2 and created essentially the VWAP minus a quarter of the range, and that is what I call the 0.5 MPD. So if you are a trader who likes the idea of counter trend trading, where the market is ripping lower or coming lower, and you think that the break is short-lived and you think there's an opportunity to buy, if you were going to be relatively conservative and you had a reason to stay long, then you might be waiting until this market reaches this maximum permissible deviation before you think about getting long. All right, now what is the trigger for getting into one of these long trades? Well, one of the things you can use in a market that is falling like this, especially one that's falling quickly, is an oscillator like a CCI. So in this type of a situation, the CCI is breaking lower, it breaches that negative 200 level. This is going to be a pretty violent move. You're going to see the market moving relatively quickly through these levels. And a lot of times what I'm finding is that when the market peters out and starts to recover, that's when you're going to see the oscillator start to recover. So if you see at the same time the market is breaching this bottom end of this range, which again, this MPD range here, you will often see that the market eases. It's, it takes its foot off the gas a little bit to the downside if the oscillator it looks like it's starting to recover. All right, so if you're really impatient or you got deep pockets or you don't mind scaling into a position a bit early, you could use the half level. Okay, so if the market were to breach down to this half level of the maximum permissible deviation, that's when you start to say, okay, are there signs that the market is petering out right now? And if there are, or you're willing to put one on here, this would be a place that you look to buy one contract. Okay. If you want to be more patient and you really want to wait for one of these outlier type moves to occur, you could wait for that market to get really close to that maximum permissible deviation before you take a long position. Now, the cool thing about the Russell, going back to what we were talking about before, is that let's say that you did, you were looking at the CCI breaking down here and you wanted to put one contract on as the CCI began to recover. And let's just say you were early. So let's just say as an example, you put one on like right in this area here at 1529.50. I think with the Russell right now, you need to use a stop. If you don't have insanely deep pockets, okay, and you know that you're better off taking maybe 1 or 2 or 3 trades a day instead of trading 40 or 50 times a day and then paying all the fees associated with that, and you lose the same amount anyway, except for with all the fees on top. Okay, if you've already been through that and now you're trying to scale back the amount of trades you're taking, you could make a strong case for a $300 or $400 stop. It might sound insane to hear me say that because a lot of times you folks are being taught to use 6 tick stops or 12 tick stops or 15 tick stops or something like that. I just think it's really hard to do that right now. So I think most people would be better off if they took fewer trades and widened those suckers out a little bit and give this thing a chance to breathe. So if you were to risk 8 points on a stop like this, which is an 8 tick stop in this contract, that puts you all the way down to 1521.50, like right in this area. That is a dramatic move in the Russell. That means the market has to make the entire move it already just made again in order for you to be stopped out. I would argue that unless there is some sort of like terrible news happening or there's some extreme catalyst, if you are getting long as the market is hitting that maximum permissible deviation and the oscillator is starting to turn back, it is relatively unlikely, I think, that you're going to get stopped out here before you have a chance to exit that position. The only downside to doing this is there's a degree of counter trend trading that's involved that some people physically just can't handle. What I mean by that is they buy one here. If the market does get down to here, they're going to cancel the stop, add to their position, and then eventually add to their position until they blow out their account. Okay, if you're going to do that, you can't do this. Okay, so that's one downside. You have to look at yourself honestly and say, is that something that I think would I fall into that trap? If the answer is yes, this is not for you. Okay. The other downside is that this doesn't happen very often. The market doesn't hit that maximum permissible deviation over and over and over again in one market repeatedly throughout the day. So if you're going to do this and you want to have more than 1 or 2 opportunities in a session, you have to look at multiple markets. All right. So that's where we get into some of these other products that I don't really want everyone in my customer base trading right now, depending on their capital structure and penchant for risk. But I'm not saying you really necessarily focus on the NASDAQ, but there are some similar occurrences in other products. Like there is a pretty similar occurrence here with crude oil today. Okay, so this is that maximum permissible deviation. Here's the 50 range. So if you buy the half of that, you're taking a beating on this. If you wait until that maximum permissible deviation is approached, you are now in a pretty good position. The market breaks below it. It tries to hit it a couple times. It breaks below it. The oscillator turns up. Things are probably slowing down right around this area. I wasn't watching crude right at 10 or 10:30, but obviously that's what happened. Okay, the market slowed down a little bit and then it begins to recover. And so if you're using, let's say, a 30 to 40 cent stop in crude, which is $300 or $400, the only way for the market to stop you out in that position is it's got to make an extremely dramatic new low for the session. Okay, so you're just wrong. I mean, in that case, you're just wrong, and that's okay. Being wrong on something like this and sucking up the $300 to $400 loss is better than being wrong on a 10 tick stop, 4 or 5 times a day or 8 times a day, and then with all the fees and the frustration and the feeling of being tagged out and then watching the market run the other way without you 10 seconds after you get hit, right? So there's a difference in losing. And losing is losing at the end of the day either way, but it's a different kind of losing. It doesn't feel as bad. And it certainly is not as mentally debilitating in my opinion. So if you're going to be the type of trader where you're going to wait for these things to be hit, then you just have to be patient and you have to look at situations where this is happening across more than one market at a time. That's the beautiful part about this kind of strategy, is that there's no real special indicators on here. This is all range-based stuff. The only thing that's unique at all is the CCI, and how is that unique in the first place? It's really not unique at all. Here's an example too of the Dow doing a very similar thing, right? So you've got the market hitting that maximum permissible deviation a couple of times, okay? Depending on how early, you could argue that you'd want to stay out of it after that first, or until that first half hour is up, but not necessarily. Even if you took it here, there's an opportunity to exit the position. And if you took it here, you might have gotten stopped out. If you took it here, you're definitely still in the trade, right? Or most people would still be in the trade. But again, like this is another situation where if the market breaks below that level and you see it start to calm down a little bit, and the way that you can judge that, it oftentimes is by the use of an oscillator. And it doesn't have to be the CCI. It could be like a stochastic or the MACD or something else that looks like this, okay, has a similar behavior. Then this is an example of the market slowing down and the CCI started to recover a little bit. So I mean, this is an idea that I think requires a lot of patience. It requires a person who is confident enough in their decision-making ability in the live side that they will not add a position until the cows come home and the account is gone. Okay, so very similar to that whole value area breach thing that we talked about before. If you're going to take a counter trend trade or a trade that is getting into a position where you might not feel like you're taking a counter trend trade because you really are waiting for some kind of recovery, but you are buying the market when it's weak. So I guess sort of by definition, you are doing some kind of counter trend trading, even though you are waiting for that little recovery. You just have to be the type of person that can take the hit if it doesn't go right. I just think that it's a lot better for my clients to be, to risk, instead of risking $600 or $700 in a day on 48 to 95 contracts, to do it maybe on a 1 or a 2 lot 2 or 3 times a day, and not necessarily risk any more money, and have a trading strategy that is way less stressful. At least to me, it would be less stressful. So does anybody have any I haven't really talked about the mechanics. I'm going to go through some of them here, and obviously we'll make the files available, but there's some questions coming through that I wanted to address as well. And please feel free to ask. This would be a good time to ask some questions if you have any, okay? Emani Mom, about the Unirenko chart, are we going to add Unirenko charts? I don't know if there might be something similar to that already. I'm not sure if it's exactly the same, but Sierra has like 3,000 different Renko chart capabilities. So if there's something that we can try to mimic or get close to, maybe we can use that as a basis, okay? Greg says, you need to use average true or average ATR, average true range, to help determine volatility and stops. Do you use ATR? Okay, so that to me is not accurate, Greg, okay? And I'm not saying that to be a jerk, but I don't want to use the ATR because I don't want to look at stuff that happened too far in the past. That's why I'm trying to get away from the ATR. Even the CCI, I think this only goes back 10 periods. Okay, this CCI only goes back 10 periods. What is a 10 period ATR going to tell me? It's not going to tell me anything. I mean, I don't really think that that's going to be useful in this situation. I think that people have to make a judgment call that has a lot more to do with okay, if the market finds rare air to the downside, let's say, rare air meaning like this, the market is ripping into this open space it hasn't seen in a while. That's where I will get stopped out. Okay, I'm probably okay with that. I was just wrong. So I think that that's really subjective. I think the use of like things like ADX or ATR in this situation kind of defeats the purpose of getting rid of these other indicators, because a lot of that stuff I feel like if it looks too far back in time, it's old news. I think that right now I think that's an important consideration. Joe says Flex Renko from Sierra is very close to Unirenko, right? Okay. Emeni, let's the Murray math thing. Obviously, that's not really central to the discussion here. Maybe we can try to, take that one out of the room. Okay. I don't mean to be rude. It has nothing to do with what we're talking about right now. Okay. Steve says I love the new mouse pointer. Yeah, good. I think I'm switching to the gray screen. I think I'm going blind watching that white background, so might be switching to the gray screen. Do I use any specific settings with the CCI? No, not particularly, Lori, except for the fact that we use a 200 for the line value. So the 200 and the negative 200 are basically to illustrate an extreme move. So what I'm basically seeing is I'm only seeing, this recovery if I'm looking at the market breaching below that 200 level or getting really close to it first, because the 200 level is not usually maintained for very long at a time. It usually punches through it and then comes right back. Very few situations you're going to see the CCI hanging out above 200 or negative or below negative 200. Okay, so the MPD line, I'm going to explain that in a second, Skip. That's a good question because it's not like a regular indicator. All right. Ezra says, I've been trying to trade the M6E based on your suggestion. I find it difficult because it seems to make shallow moves. I wish there were a measure of how well a particular future trends. Yeah, I mean, a lot of times people do look at the currencies for their trending moves. The other problem with M6E, Ezra, is that it's just so small that trading one contract doesn't yield anything. You may even want to look at if you think it makes big enough moves where if it were a little bit bigger that you could probably make something work, then you could either trade more of them at a time. Obviously, you're going to pay more to do that, though. Or you could also look at the E7 contract, Ezra, which is half the size of the full-size euro. So there are half-size currencies for the euro and the yen. So E7 is the half-size euro, which is basically a 62,000 unit contract, I believe, rather than 125,000, which is the full size. So it's got half the bang for the buck. So maybe that's something we can talk about. Okay, so E7 is the half size euro, and then J7 is the half size yen. Okay, J7 and E7. Okay, the tick value of the Russell, Rob, is $5. Okay, so it's a $5 tick. All right. Okay, so let me try to show everybody how we came up with these various levels here. And that's going to be sort of like the mechanics side of the lesson today. I know this one was a little bit more theoretical in nature, but again, I mean, it's in everybody's best interest, I believe mine included, if I can try to help people slow down a little bit in this situation, in this sort of situation. So I really want to stress how important I feel this is. All right, so what I'm going to do is duplicate this chart here, and I'm going to put these tiled on the screen next to each other. So this is the exact same stuff. Now, for the sake of clarity, and you know what? Before I do that, actually, let's do this. Hang on a sec. Let me get rid of this. I'm actually going to remove all the stuff that's not relevant right now. Okay, so we're going to come back to some of this. I'm going to remove or I'll just hide some things here. So I'm going to hide this is the daily open, high, low, close that refers to yesterday. I'm going to hide that. I'm going to hide the CCI. I'm going to hide the first 30-minute range, the value area lines, the overnight high and low, and these are automatic trend lines. I didn't cover that. This is a study called Automatic Trend Lines. Mine readjusts every 5 bars. It's kind of cool. I actually like it when the market breaks through them because it shows how false trend lines can be. But I actually don't. These readjust every 5 bars, so it's a nice way to automatically have trend lines drawn on the screen. Especially if you're looking at multiple markets, you don't have to redraw them. So that's kind of a neat thing. All right, so I'm actually going to hide that as well, just for now. So that's going to clean things up a little bit. Okay, the midpoint as well, we'll hide that. That's in the daily open, high, low, close study. Okay, so now what we're looking at is just the bands, except for this line that I drew. Let's get rid of that. Okay, now let's duplicate this and tile it on the screen. All right, so here's how we get to this situation. What I'm going to first do is go to the studies section, and I'm actually going to show you one by one how we got these lines to be drawn. So the first thing is there's a study here that's called daily open, high, low, close. Okay, it's hidden right now, but what the daily high, low, close is doing is it's plotting based on 0 days back. So when you add the daily open, high, low, close study, if you put this to a 0, it means it's looking at the daily open, high, low, close of today. The default for this study is 1. Okay, reference days back 1. Okay, that means that it's looking at yesterday. So if you add the daily open, high, low, close study and don't make a change to it, this default will reference 1 day back in history, and you will be seeing yesterday's open, yesterday's high, yesterday's low, yesterday's close. All right, mine I changed to 0, and in the subgraphs tab, I actually made the open and the close set to hidden. So I'm not even looking at those. All I care about is the high and the low of today. I also check the name label because I want a label here, and the value label because I want the price label. So I want the name label and the value label. That's what these are. Let's make this visible on the screen here so you can see these again. Okay, so there's the high up here. Okay, there's the high. Okay, and then the low is right down here, kind of near this MPD line. Okay, so the high up here and the low down here. And then the midpoint is here as well, but that's not relevant to the calculation. All right, so it's important to also know that we're going to basically be using other studies that are basically what Sierra calls arithmetic-based studies to generate these MPD lines. So the first thing that we have to do is we have to create the range of the day. So I'm going to unhide this study here, and this one here, and this one here, and you're going to see these things show up at the bottom of the screen. And what these studies are, this is a study that's called study subgraphs difference. Study subgraphs difference is how you can subtract one subgraph from another subgraph. So a subgraph is like a piece of a study, like a moving average has a subgraph, and that subgraph is the line. All right, a MACD has a subgraph. It has several. It has the differential, the MACD moving average, the zero line, etc. Right? Well, the daily open, high, low, close study also has subgraphs. So what the study subgraphs difference study does is it allows you to pick something and subtract something else from it. So when you add this study called, again, study subgraphs difference, it's in the left-hand side, it's all the way down, it's alphabetical, so you'll just look down here. You're looking for study subgraphs subtract / difference. Okay? And what you'll do is you just basically pick 2 inputs, and you're basically subtracting the second input from the first, and it yields a value. In this case, for input study number 1, I have the daily open, high, low, close, and I'm picking the high. And then for input study number 2, I have the daily open, high, low, close, and I'm picking the low. All right, when I apply that, it yields a value, which is a fixed value. It's a straight line because the line doesn't move unless the high or low expands on the day, right, or the range expands. So if we look down at the bottom of the screen, that is this value right here, 34.9 points. It's the high price up here minus the low price down here yields 34.9. All right. Then what we did was there's another study here that's called study subgraph divide. And it basically allows you to take any subgraph and divide it by something, whatever you want, okay, in terms of a number. So what I did was I added that study. It's called study subgraph divide. Okay, it's also in this list, study subgraph divide. Okay, and I picked the based on in the top left corner. Most of your indicators are based on your main price graph, but what if you wanted to have a moving average that was based on volume or something that was based on something other than the main price graph? That's what this dropdown is for. So I'm changing the based on from the main price graph to this high-low result, which is this value. And what am I dividing it by? I'm dividing it by 2 because I want to see half of the value. So high-low, okay, in the input data, it's the high-low differential divided by the value of 2. And that yields this 34.9 divided by 2 equals 17.45. Okay, so now you're starting to see, hopefully, like where these values are coming from. Okay, so this is the range of the session. This is the range of the session divided by 2. All right, well, if we go back to studies here, you're going to see these studies that I called upper band, lower band, and lower band. So the upper band here is another one of these arithmetic studies. Study subgraph add. And I'm picking what do I want to add to what? Well, I want to take the VWAP, which is that black line we talked about, and I want to add this result. So that is how this blue line is being calculated up here. It's the input study number 1, which is the VWAP itself, plus the result of this high-low range divided by 2, and that yields this up here. And there's another one to the downside here, the lower band, which is basically study subgraphs difference, which is like a subtract. So I'm taking the VWAP minus the result right here. And those are the 2 that I started with. What I found, as you can see, is that there were situations where this line wasn't getting hit that often. And I knew I would have customers who were telling me that this doesn't happen enough for it to be worth following. That's why I added this half value in here. So I basically created a high-low minus 4, okay, which yields this value here, and I use the same function to create a mid-level upper band and a mid-level lower band. All right, so I want to demonstrate in another chart book here just an example of like how this looks from scratch, okay? So just we'll make this relatively quick, but let's just take a S&P chart, all right? And I will add a, let's just say, I'm just going to add a moving average. Okay, so there's an 8-period EMA, which is my default setting. All right, let's just make sure we can see the value in there. Yeah, it's right behind the current price. So a little tough to see, but there's our 8 EMA. Okay. Now, let's say that I wanted to track some sort of derivative of the EMA. So some sort of arithmetic-based value of the EMA. All right, one thing I could do is I could say, all right, well, let's take the moving average and let's multiply it by, some factor. So I would go down to the study subgraphs and look at all these different studies that are related to arithmetic functions. So study subgraph multiply, for example. If I click add and go into settings, study subgraph multiply, I need to pick a multiplier. So let's use the EMA. So we're going to base it on the EMA, so it changes our input value to the average. And let's multiply it by 1.05. Okay, and I'll just leave it in region 2 for now, which means the result is going to appear down here. I'll just thicken the line up and let's just make sure we can see it okay. Like this. All right, so that's way above the market, right? 29.29. So what this is doing is this is taking the EMA and it's multiplying it by 1.05. So if I just wanted to reduce this number a little bit, okay, well, actually, you know what? Before we do that, let's put this in region 1 so we can see how it looks. All right, region 1 is the area where the main price graph is up here. Okay, so way far away from the market. So let's just take the multiplier now and go down to 1.01. Okay, now it looks like this. So this is basically the ADMA 1% higher. And this is an example, I'll go even a little closer here, of how you can use the arithmetic studies to create bands that represent a range of whatever the line is you currently look with like a little margin for error. Okay, could you make a custom study out of all this? Yeah, you could probably make a custom study or have a programmer do it if you couldn't do it yourself. Sure, yeah. All right, so if you have these ideas and you have something that's consistent all the time and you want to make it into a custom study that you can add all at once, you could definitely code it if you have the knowledge to do so. Okay, what I'm doing though really doesn't require it, but you certainly could. Dave says, so the MPD is part of the VWAP. It's not part of it. It's based on it. So the MPD is based on the VWAP plus half of the day's range, and then the lower band is the VWAP minus half of the day's range. So it's essentially taking a value that is commonly tracked among traders, the VWAP, and it's adding a Bollinger Band-like band around it that is based on the range of today's session. So it's extremely current. All right, it's extremely current. That's what draws me to the idea. The mechanics of it are really not that hard. It's just you just have to be able to use Sierra in a way where you can Sierra is like you're in an orchestra and you have all these tools here. You just have to know how to direct it. Okay, and it can sound daunting, but there are some functions that exist here that regular people like me, you just have to know where they are. And it took a lot of fooling around for me to create this. All right, but if I can do it, anybody can do it. All right, there's no programming whatsoever. You just have to be able to think in your head what it is you're trying to accomplish in English. Just think like, okay, I would like to be able to create, some sort of a band around the VWAP that was based on today's range. Okay, that is something that's logical and can be defined. That's something you can do inside Sierra without programming. All right, so this is these examples, these arithmetic studies are just there's probably only a handful of them you'd ever use, but some of these are very, very useful. The study subgraphs difference would be a way for you, for example, to subtract one chart from another chart to create sort of like a spread chart, or to subtract the value of one indicator from another indicator, kind of like we did with the VWAP. So these arithmetic studies are quite powerful. And what I essentially used in this one here is a series of them to get to a place where I could create these bands. Okay. Scott says, yeah, you have to get ready for the game. Will this be recorded and emailed? Yeah, Scott, we put them all on YouTube. All right. So if you can't watch the rest of it, there's not much more anyway. But if you want to watch the recording or you want a copy of the files, then definitely send an email and I'll make sure you get the recording. Okay. Yeah, absolutely. All right. Okay, so let's just do, let's try and go through one more example of this, kind of from scratch before we wrap things up. All right, I'm going to tile these vertically on the screen. All right, so I'm actually going to remove all of these little studies here that are not directly related to the screen as it stands. Okay, I'm going to show you how to do this from zero. So we have the VWAP, and I don't really need this high-low study here. So we really just have the VWAP and today's range. Okay? And this horizontal line that I didn't delete. All right, so the first thing is we need to find the range. So we're going to go down here and we're going to look for study subgraphs subtract / difference. Okay, so I'm going to add the study. Okay, and this is the relevant study here. It's ID number 2, daily open, high, low, close. So in the settings section, we're going to base the study. Oops, excuse me. I'm on the wrong one here. Sorry, settings. We're going to base it on the daily open, high, low, close. And the first input is not going to be from the main price graph. It's going to be from the daily open, high, low, close. Okay, so daily open, high, low, close. We're going to do the high. And then daily open, high, low, close. We're going to do the low. And we're going to put this in region 2. All right, it's giving us a line. There's really not much that's telling us about the line. That's because we really haven't formatted it all. Let me thicken the line up a little bit, put a value. Okay, 34.9, kind of like what we saw in the middle chart. So there's our range for the day. So all we had to do was do study subgraphs difference, and then the settings and inputs, pick the correct inputs, the high minus the low. All right? Now, what we're going to do is we want half this value. So we're going to use another arithmetic study. It's called study subgraph multiply. All right, study subgraph multiply. So I'm just going to add it. And in the settings section, we're going to be basing this study on the difference that we just created. Not the main price graph, but the difference. And what is the multiplier going to be? It's going to be 0.5. We will stick this in region 2, so it's in the same region as this one, so it's not, we're not ended up with stacks of regions down at the bottom. Let's format this similarly, like this. Okay, there is 0.5 of the range. So that is 17.45. Okay, now what we're going to do is use the study subgraphs add study to add one subgraph to another. So one of the subgraphs is going to be the VWAP, the other one's going to be this half range that we calculated. So we could do settings. What are we going to add together? Input study number 1, do we want it to be the main price graph? No, we want it to be the VWAP, with the VWAP as the main VWAP line as the first subgraph, multiplied by that study subgraph multiply result that we created down here. And this one we will put in region 1 because this is going to be our band. This is going to be our upper band. So when I apply it, we're seeing that up there. And I'll just format this in such a way that has some familiarity, like this. So that is our upper band right up here. So that is the VWAP plus half of the day's range. All right, and then we could go down here and also do the study subgraph subtract, or excuse me, study subgraph subtract slash difference, because we're subtracting two subgraphs, one from another. Okay, not just subtracting a number from a subgraph. So I'll just add that in the settings section. We'll do the formatting now, why not? Let's make it a different color. And in settings and inputs, what's our first input? Well, it's still the VWAP. And then the second input is going to be that multiplier that we created. And this is going to be in region 1. There's our lower band. So the idea here is that we just created this MPD using a series of arithmetic studies that are coded already for you in Sierra. You just have to be able to, do one step at a time, and then once you have it looking the way you want, you could just hide the, everything in region 2. So that's going to be this difference. We'll hide that. The multiply, we'll hide that. And then it goes away, and we're left basically with the MPD. And everything else just goes on top of this. Okay, value areas, the CCI, the overnight high, overnight low, first half hour, high and low, all that stuff. All right, so this is, if you're doing something like this, I would do the main meat of it first, like this, and then the ancillary stuff can go on top of that. And then from there you can create alerts, and the possibilities are basically endless. But I would encourage everybody right now to request a copy of the file and consider incorporating elements of sort of level-based trading into their analysis, because when you do this, especially when you create studies that respect volatility in the market by basing themselves on ranges, you might force yourself to be a little bit more patient because you just might not get as many signals. So this whole idea with this MPD thing, if you're aggressive, look for that half MPD. Look for an opportunity if the market is approaching that down to the downside and you see an opportunity where it looks like it's petering out and you want to go long one, fine. If you've got a bigger account or you're willing to take a little bit more risk, you buy another contract at that lower level and you have a stop in for both somewhere at an acceptable level for you. You don't need to trade a lot of contracts with this kind of volatility to make or lose a lot of money. Okay, it's just not necessary. And you can get away with spending way less in transaction fees using a strategy that requires the market to approach these relatively extreme levels before you get into positions. And if you do this over a couple different markets, maybe 2 indexes, one currency, one interest rate, one commodity, you're probably going to have enough to keep you busy throughout the day. I doubt you'll be sitting there, not doing anything for too long. Okay? So I think that's probably where I will leave it for now. David, yeah, you could do any number. It doesn't have to be 0.5. Like I used 0.5. You could do another instance where you're using 0.7 or 0.75 or something like that if you want to create these additional bands. It's just a matter of using the number that suits you, right? So you certainly would be able to use whatever value you want. I just chose to use the range divided by multiplied by 0.5 and then multiplied by 0.75, or excuse me, 0.25. But you could do it, whatever numbers you wanted. Okay. So I think that's, folks, I think that's probably where we will leave it for now. I know that, this is it's not the most terribly exciting, series of logic points to follow when it comes to this arithmetic stuff. But I think that it's a unique aspect of the program, and it's relevant right now based on volatility we're seeing. And I think that if you are finding that, these indicators that you're using are just getting ripped through, I don't think you have to get rid of them forever, but you might find that when you look at these levels and you realize how far the market, in theory, it's a terrible phrase to use, but how far the market could easily move, even as it rips through your indicator, it kind of puts things in perspective. It's like, well, what was I thinking? This is crossing this here, but look how big the range is. I mean, it doesn't mean anything. That's the goal, is to put in perspective, the range that we're experiencing in this session, omitting and forgetting basically about all prior historical data beyond the prior session. Now in the big picture, you're going to look at the 50 period and 200 period moving averages and all that stuff. Sure, if you want to, but for the shorter term day trader, I'm not sure how relevant that is. If you're looking at those sorts of things to establish a bigger picture view, that's one thing. All right. Okay. All right, folks. Well, I think that's probably where I will leave it. Please feel free to request a copy of the files from us. I'd be happy to send them to you. Hopefully you're getting something out of these presentations. We're going to be changing the format a little bit next year. We're going to be doing a lot more shorter videos, and we're going to be basing a lot of our content on a lot more suggestions. So we're really going to build out that charting club stuff. We're going to keep the YouTube stuff going. We get a lot of interest and hits, via YouTube, and we certainly don't want that to stop. So we're going to continue to push that. And we're going to be, doing a lot more relevant web content next year. A lot of things happening in the Infinity office now that we're discussing about, the coming year. So if you have feedback, send it to our management, trade@infinityfutures.com. Most of you here know Jim Cagnita. He listens. So if there's things that you're looking for, content that you want, or stuff you think would be relevant, please by all means send it to trade@infinityfutures.com. It'll go to Jim, and he'll put the wheels in motion. All right. Okay. All right, cool. Well, thanks everybody. I appreciate the comments. Thanks again for coming to the presentation today. Please tell your buddies and your trading friends online how much you enjoy our presentations and how relevant and consistent they are. It really means a lot to us. The referrals are a huge part of our business, and if you feel like your online trading friends and people colleagues could benefit from working with a firm who cares about their clients to this degree and is willing to put this sort of information in front of people at no charge, we certainly would love the opportunity to get in front of them. All right, folks. Thank you again. Much appreciated. I'm going to read some risk stuff here, and then we'll wrap things up. Everybody have an excellent evening, and we'll see you next week. Okay. All right, folks. Trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All righty. Thank you, everybody.